So, Justin, can you hear me over there? You good?
Loud and clear.
All right. So with that, we will get started. I'd like to welcome everybody today to our first quarter conference call for 2021. Just a quick reminder that everything that we discuss today is for informational purposes only, and none of this is intended to be construed as investment advice. I'm going to get our PowerPoint here launched so we can kind of all follow along the same. If you have a question, we've got, I think, a way to see questions that you type in, and we've got a couple folks here monitoring that. So if we see your question, we'll get it answered on the call. And if we do not see it, we'll definitely follow up with you shortly thereafter.
I'm a panelist. I don't want to be a panelist.
What was that, Justin?
Huh?
Okay, so with that, we'll get started. I do hear some discussion. I think John is in the background, so I can hear you guys.
Oh, you can't see over.
So yeah, John, I can hear you, just so you know. All right, so I just thought I'd throw this interesting slide out here to kind of really exemplify 2020. You know, obviously COVID has been a really tragic situation in a lot of different aspects, and a lot of things are shut down. Some, have come back on, others never really felt much of it, but it certainly feels like much of the world is closed, and much of the normal things that we do day to day are not the things that we would like to do, in terms of not being able to travel and not being able to do business normally the way we do it, not being able to interact, and all of the difficult moments we see with social unrest and political theater is a little over the top. So crazy times. But with that, let's talk a little bit about what we can take away from our 2020 economic recap. Depending on the sector or the type of stocks that you look at, you will see, looking back, that the markets finished up in 2020, which is really a testament to the resiliency of markets. Some of the things like the Dow were lower digits, 6 or 7%. Others, S&P and more tech stuff was up in the double digits. So a very big ending positive after seeing a beginning of the year have declines anywhere from 20 to 40%. And interestingly, from a client perspective, none of us really have a problem with the up. It's when things are down that we tend to really second guess ourselves and worry and create tough moments for decision making. So 2020 definitely created an environment where everybody was tested to some degree of their resolve to own stocks for the long run. Also, another hallmark of 2020 was unemployment. The recession that COVID created spiked unemployment to a 50-year high, up to 14.7% mid-year. That's a pretty dang bad unemployment number relative to anything we've seen in the past 25 years. And even now, with a lot of industries trying to find ways to get back to work and get people back to having some productivity, we're still at 6.7%, which is the highest we've seen really since about 2013. So certainly not catastrophic, but still very elevated. Another very substantial piece that we'll remember 2020 by is the amount of combined stimulus that the federal government injected into the system, over $7 trillion of different supports in different ways, everything from PPP loans to sending out people money to go and put in their pocketbook to help pay bills, to this massive amount of money that was purchased into the bond market from the Fed, and on and on and on. Industry bailouts, just unbelievable. But $7 trillion, the magnitude of that quantity of dollars inputted into the system is quite historic. I think back to like the housing crisis and the TARP programs and this troubled situations we saw back in 2008, 2009. I think we landed around $800 billion in total support to solve that crisis, this was nearly, 8 or 9 times that much stimulus. And I think that's a part of the reason the market actually finished up for the year. The money has to land somewhere. And then on interest rates, unprecedented lows. As we sit today, not a lot of hope for bond investors looking forward to actually make real positive returns. Certainly wouldn't anticipate outperforming inflation unless you're taking a pretty high amount of credit risk or, long duration. So that's a heck of a year. Justin, anything you want to add?
Yeah, real quick, if you go back to that slide. So you almost don't want to go back and revisit February, March, April timeframes, but market drawdowns, we talk about that, but human beings have an amazing ability to forget things that happen relative. I mean, markets were down 10+% in days, 10 to 12%, huge moves. The volatility was out of control. And then on the federal government, I mean, I tend to get lost in big numbers, trillions. I mean, you start saying things and they don't even mean much, right? But to put that in perspective, almost $1 out of every $4 of U.S. currency currently in circulation was printed in 2020. Yeah. Almost $1 out of every $4 around, right? That's major. So it's big numbers.
Yeah. So, obviously for our clients and things, and we've managed the process, and we kind of look at our job in different capacities. And so we want to do something a little different this year and talk a little bit about giving ourselves like a report card. And I think the goal is we always want to try to make ourselves better. And I think that's just a healthy part of any business and any sort of organization where you're just trying to be the best. So we decided to give ourselves some grades this year on how we did on sort of the 3 major areas that we feel like we contribute to people's lives. And so we kind of broke it into 3 groups, sort of net investment results, the amount of actual panic, turbulent drawdowns that our clients experience and made decisions based off of those emotions. And third, like the financial planning piece, like the things that we did for people this last year that worked out really well given the situation for the year. So let's walk through these real quick. So I'm going to start, we give ourselves a C, which sadly, I'd love to tell you we got an A. Some years we get an A. Last year, we're giving ourselves a C on net investment results. I think our more conservative clients probably didn't really lag that much, but I know on the aggressive side, we tend to have processes in place that are more concerned about not losing. And, as the markets have become increasingly volatile, we tend to kind of stay in a historical sense of this is how much volatility we're okay with. And I think that makes us make decisions that are tricky. But there were 2 things that happened this year. And I hate to make these conference calls complicated because I know some of you, this is not your cup of tea, but I want to try to let you know that we recognize 2 things that we did this year that we feel like if we could go and do it again, we would make a better decision or more informed decision. In our trend process, when we, come out of stocks because the market's going below a certain threshold and we go to safer money, historically, we have been able to, manage that process a bunch of different ways. We had one particular component of that process where we outsourced some of it to create some diversification, how we get it done. And in one of our outsourced components, we ended up having basically a 2% underperformance to our other trend strategies. So we actually have taken measures to remove that piece of our trend and replace it with something that we think will do a better job. But, the concept of getting out of harm's way when things are getting crazy is a good concept, but it's the execution of it that can be really dictate the actual net returns you get. So we had one piece of that process we felt like disappointed us in the execution, and it lost about 2%, and we just weren't able to make that back. One other piece is that when we do come out of harm's way and we move money out of the markets and we go to safer types of things, historically, we found investment grade bonds, short duration investment grade bonds, to be a good parking spot. In this year, back in March, after we had moved money out of harm's way on the stock side and went and parked a lot of that money in short-term investment grade bonds, a phenomenon began to ensue in the bond market where there was essentially a liquidity crisis and people were selling bonds to deal with all sorts of deleveraging things going on in the market. And the market got unstable and it started falling in the bond market almost on a historic level, so much so that a couple of days into it, we had to make a move out of that and just go straight to treasury type holdings to make sure that we didn't take safe money and lose money on it. And in that moment, when we did that, it ended up costing us to lose about 2% on those safe money accounts, which 2% is a big number in the bond world. And what we didn't know was that literally a couple of days later, the Federal Reserve was going to come in with an unprecedented historic move and say, we're going to buy all of the investment grade paper necessary to stabilize the market. That's never happened before. It couldn't have been predicted. It's still a shock, honestly, to kind of goes against the concept of capitalism. You know, if a company's losing money on their note, generally because something's going on that is a problem. But for the Fed to come in and basically be the buyer of last resort, it saved the bond market from an absolute catastrophe, but it did not help us in time because we were like, we have a fiduciary obligation to not lose money for our clients in money that we're trying to be safe with. And so in that transaction, we lost a couple %. So those were two things that we feel like, you know, if we had vision to how a pandemic works and how things get crazy in moments, could have made it a little bit better. Wouldn't say it was a terrible thing because we did get back in the markets at the right times to participate. We finished mostly positive for the year with everything. And I think that we could have just done a little bit better. Justin, you want to add anything on that before we move on?
Well, yeah, you know, for most of our clients, we're not charged with trying to beat a benchmark. That's a dangerous game to play. We're trying to help you manage your situation and accomplish your goals and dreams for retirement or whatever that may be. So, you know, you could have stayed invested, but bringing into play losing 50, 60% of your investments may not be the right strategy. And then with our defined risk strategy, it is designed to protect against that sustained drawdown, a timely, significant loss,
Right.
Not as much a V-shaped recovery, which, you know, if we're just looking at the trend component of our portfolios, that works. But a V-shaped recovery is not bad because that means some other things are going to recover quicker than the trend part. But trying to beat a benchmark, you need to be prepared for that. It's just a dangerous game to play. I mean, our focus is helping you accomplish your goals.
Yeah. So those things happen. You know, I'll move on to the second piece is experience less volatility, less drawdowns. So I feel like we really did a great job here. I remember back in April, hand typing individual notes and looking at returns and how much people were down relative to the market for a lot of folks. And, you know, across the board, our clients experienced, you know, a substantially less drawdown than any of the markets. And in certain cases, the markets were down 100 or 200% more than our clients in respective types of portfolios. So our process was able to defend against the off the cliff. You know, the markets were down from top to bottom 30, 35%. Even some of the more tech heavy stuff was down like 50, or international, it could have been even closer to 50. So like for us to have experienced drawdowns from top to bottom and account values and in the single digits, and in some cases maybe low double digits, it was at least a great moment for our process to help people realize that there's some degree of surety that you're not going to be in an off the cliff, lose all your money in a crazy moment in time type activity. Like there's a management process in place that executed there. And we think we did a good job for folks. And one of the things that I can tell you, having done this for a very long time, if you look at the the returns of all of the different investment classes over the last 20 or 30 years, you'll note that, there's a lot of returns that are 6, 7, 8, 9, 10%, whatever. But if you look at the average investor return for the last 25 years, it's so substantially lower than all of the individual asset classes. And people say, well, why is that phenomenon true? And it's because individuals are their own worst enemies. We all have an emotion that we have inside of us. And when we see our account values go down a certain amount, it triggers an emotional response and people want to sell. We had very few people out of all the folks that we serve that during 2020 felt compelled to pick up the phone and say, sell all my stuff, because they understood that we had a process to protect them to some degree on the downside. And I feel like that's a huge thing, because, if people don't blow their own portfolios up in a fear trade, they really have a legitimate chance of meeting their goals in the long run by staying the course. And I think our process helped there. So we gave ourselves a B on that front. And then the last section is a financial planning, recommending cash flow stuff. Most of our clients have day-to-day decisions they have to make about paying bills or buying a car, buying a house, selling a house, fixing a house, taking a vacation, sending the kid to college. I mean, on and on and on. Life is expensive. One of the things that we did in the end of 19 and really early in 2020 is recognize the market had gone to an all-time high in a hurry. And we were very actively communicating to people that if you need money for anything substantial in 2020, let's get it out now and get that check to you early in 2020 or at the end of 19. And we just didn't have, I can't think of any substantial redemptions that I personally had to take calls for with clients that we were forced to take money out of something that was down in the months of late February, March, April, and through the summer. And now we got closer to the end of the year, and there were some things that people need to start thinking about now. And we're back in the mode of telling you, hey, if you got things you need to take care of financially, this is a great time to do it. Stock market's at all-time high. Price to earnings ratios are elevated. So I think we did a great job on helping people in the financial planning aspect, probably as good as could be done as an organization on that front. So that's sort of the three areas. We're hoping to give everybody 3 A's next year, but it's always a learning curve in the world, and we want to continue to just keep getting better. Let's talk a little bit about some strategy updates for 2021. I mentioned briefly that we did remove one of our partners organizations that we've used to help execute trend, because the process of having the trigger happen and then wait a certain number of days and come in and go out, the trigger plus days concept was one of the more pioneer methodologies in trend. We've evolved to a different process now that we think will be better. Instead of having a trigger and then wait a certain amount of days or time to activate on the trigger, the newer process that we're using involves buying options that as volatility increases, we actually can make money on the options that offset the losses in the stock. So it's a lot more fluid process. It doesn't require waiting, +1, +3, +5 days. And we think that's going to solve some execution problems that we ran into with one of our trading partners. I think that people will like that process a little better. We've updated our risk off holding strategy. When we take money out of the market because we're getting on the sidelines, we've made a collective decision that we're really not going to try to make anything on that money. We're going to use true treasuries. We're not going to try to put you in something that would, maybe make you 0.5% or 0.25% while we're waiting to re-enter. Historically, investment grade bonds have been a great place, because every time we've been gapped out, we've at least made a little interest. But we see that in a systemic type situation that we're really facing with COVID, that trying to earn a little bit on the side it doesn't help. I mean, that extra 0.25% or 0.8%, it's just not worth it, realizing that, we've seen evidence now that the bond market itself can get unstable, and we're not going to take that type of approach on risk off money anymore in the future. A couple other things that we're doing is some of the indexing. When the market's going up and everything's healthy, indexing is a very low cost way to participate and get most of the upside of the market. We're in a unique situation today because the market is really very separated. The winners are up astronomically and the losers are, hanging on for dear life. And there's this big division, even within each index, of levels of future performance expectations. When you get to a place like this, your sector selection and how much you own in each sector within indexes can really differentiate you. And so we believe that this year we're in a moment of time where there's value in trying to buy some distressed sectors. There may be some extra risk in trying to just buy the winners or the ones that are up, 80, 90% in the last year. So we're going to be using a little bit more actively managed large cap positions for a little bit of time until we see the world kind of settle down. But we think that'll not only protect to some degree against people getting hurt with money moving out of what just made a ton and back into things that have been suppressed. We think it can help because you might be able to make some money on the stuff on the side that's improving and maybe limit the exposure to the things that maybe money's coming out of. So we're going to use a little bit more active management on that. We are using, the big 800-pound gorilla in the financial planning world is, what do you do with bonds? With interest rates near zero, if there's any cost at all, you're going to make nothing. The only way you make money is if you've got a flight to safety stock event. World's on fire, people are scared, people go and buy bonds and run the prices up. But if the yield is 0.9 on the 10-year treasury, by the time you pay taxes and have any expenses and compare that to inflation, you're negative. So we are working to add some other pieces, whether it be indexed pieces that have floors, whether it's time-based exchange traded funds, some structured outcome products, and even some private REITs. I mean, there's a lot of different ways we're going to be diversifying the traditional bond side to try to get have the opportunity to make something that's not necessarily correlated to stocks. This is probably the most important slide in the whole slide deck for our investors that are moderate growth, and aggressive. We've really done some soul searching here on this front and kind of come to terms with the fact that because we have trend analysis and the market goes down a lot, we don't participate to the same degree on the downside. That because that is in place, we don't subject our growth investors to the same normal risks of the market. And in doing that, we also don't subject them to the same normal total upside of the market, because risk and return are connected. So if we're doing something on one hand to reduce risk, we're also reducing potential returns. And we kind of have come to a place where we think that we need to increase the amount of upside exposure for our aggressive and more moderate growth clients so that it's in line with what the market has increased in the last couple of years. So said another way, if you go back 10 years ago and you were to measure the ups and downs in the market, the standard deviation of the market, the S&P 500 has historically been around 13% one direction or the other happens in 85% of all occurrences, one standard deviation. Well, in the last 4 or 5 years, that standard deviation has really expanded to something closer to 17 or 18%, meaning the amount of risk has increased substantially. Our defined risk strategy takes away some of that standard deviation. In fact, a lot of it, but we haven't made offsetting more aggressive bets on the upside to basically take advantage of when the market's moving upwards. So we're going to add more stock, more concentrated stock, less bonds to the more aggressive accounts. And we're going to be doing that pretty much in the next 10 to 20 days. We're looking for entry points that make sense. The reason this is so important is if you are one of our clients and you're in a moderate growth or an aggressive growth strategy with us, and you are not comfortable taking more risk, then we need to have a conversation so we pull you down to a lower risk portfolio, like a total return or balanced or income. Because we feel like that there's an opportunity at work here, not necessarily this year, but for the next 10 years to really make good returns in equities, but we've got to make sure that we own more of them on the upside and are willing to take more risk to do it. Justin, you want to add anything on that?
No, I mean, I think as an overall theme of our kind of investment strategy long-term we've often talked about win by not losing. And that's born really in mathematics. When you start to talk about, and we've talked about it many times, the drawdown math, right? If you lose 20, you got to make 25 to break back to even. If you lose 40, you got to make almost 70. So that's still prudent. We're still going to honor that in portfolios. But for our more aggressive clients, we want to give them what they're asking for. So if they want aggressive growth, then I think that's where this is most appropriate.
Yeah. All right, moving along. Sort of we'll call it market insights section. Just want to give you some data to kind of put some perspective. This is a chart of the S&P 500, the largest 500 companies in America, last 25 years. Obviously a lot of ups and downs. Just a couple little takeaways from where we are today. Obviously we're at an all-time high or close to it. We are, we had an amazing run from basically the beginning of 2009 till recently. It was up, market went up 400% if you own just those stocks. But the sell-off that happened this year was pretty substantial, 34%. And then it recovered dramatically. Again, I think a lot of that dramatic recovery has to do with so much money being injected into the system. I mean, as Justin mentioned, 1 out of every $4 essentially wasn't even in existence a year ago. And that money has to go somewhere. And if it lands in a household that has investors that don't have needs to spend it, then it gets saved or invested. And as it gets invested, it's got to go somewhere. And it's clear to us, a lot of that money's landed in the market. Now, if you look at PE ratios, price to earnings ratios, and this is based on what analysts think stocks are going to produce in earnings in the next 12 months. We see here that price to earnings ratio is currently reported at 22.3% for the S&P.
A conference call here.
That is elevated higher than most other times that we've seen, right? The only other time we've seen something in the 20s was really back at calendar year 2000, kind of the dot-com period. On the surface, that's alarming. It's like, that's really high. We could lose a lot because elevated price earnings ratios. But what we do have to take into consideration is that earnings are expected to be substantially higher in the next couple of years once we get past COVID. I can hear Brett, I think. Brett, were you trying to add anything? Maybe not. Okay. Just to show you here, the standard deviation historically, again, 22.3 times earnings is elevated. Gravity tends to make things revert to the mean. So we have a high degree of expectation that the price to earnings ratio will go back towards the long-term average. I don't necessarily think that it means that that we'll have to have a sell-off. I think it means that we have to have higher earnings. So let's look at the earnings forecast here. Actually, I'm going to come back to that. I think I have, no, I don't have, I didn't put that slide in here. I apologize. Well, the earnings forecast for the next 2 years is pretty substantially higher than they are for this year and for next year. And so if you have higher earnings and the same number of shares outstanding, that by itself will make this PE ratio show up lower. Let's talk about the difference in the actual market. So look at this slide. This is a chart of the price to earnings ratio for the top 10 stocks in the S&P 500 relative to all the others. You can see that, the value of the top 10 stocks is essentially selling at 172% to the long-term average price to earnings ratio for the top. And the rest of them are only selling like about 127%. So there is this very real separation of where the money has gone. There's crazy amounts of money that have gone to the top 10 holdings, and there's only a little bit more than normal that has gone to the remainder of the holdings. this is where I believe active management is really going to be powerful to help us. We want to have more active management so that as we see sector rotations, we might be able to make something as the market tends to come back more towards normal, rather than just indexing and then seeing some of those high flyers maybe give back quite a bit. Justin, would you like to add anything on that?
Yeah, so I nobody knows the future. We can't. 2020 taught us that very strongly. But if these concentrated names continue to drive the index, the trend following aspect of our models will continue to appreciate from that, because they're tied to an index. So if we're wrong, and that's one of the beauties of trend following, you don't have to be right. Whatever happens, we're just going to ride the trend. So if they continue to appreciate, we can capture some of that. On the flip side, as we've mentioned, and the next slide proves it out, I mean, there was such a discrepancy between sectors that if we do get some sector rotation, we always talk about reversion to the mean. If some of the underperformers they don't have to explode, just come back to neutral, I feel like we can pick up some price appreciation on that sector change.
Yeah, because there's pretty radical differences in the returns in the last 12 months from the different sectors. And, I would even say to some folks that are really disciplined, really long-term, really want to take a little extra risk, if you try to do some individual positions in some of these beaten down sectors, you might get paid pretty well. It's definitely not a game for everybody, because, a lot of folks that we work with don't stomach losses. And, just because they're down doesn't mean that they're necessarily going to come up quickly. In fact, a lot of people would argue they're down because they're going to expect it to stay down. But I do think there's a lot of deep value opportunities out there in some of these sectors, and we want to try to be selective about how we participate in it. One other thing I want to note on this slide before we move on, just like there's differences that are pretty radical depending on which sector that you might have chose to invest in since the end of 19, so essentially the year 2020, that also carries over into the REIT space. This graph is one of the only ones I've seen in a long time that include the different real estate pieces. So REIT stands for Real Estate Investment Trust, but there's different sectors in real estate. And we've heard a lot of doom and gloom and worry and concern around office, real estate, residential real estate, even retail real estate, and those have been hurt a ton. But the industrial side, it's up 15%. So industrial and logistics tends to be more of like a staple. Like those businesses have to exist. They can't just say, well, we're not going to use the space anymore. So we do have some folks that do some real estate related stuff. And I thought this was great for you to kind of get a chance to see that not all real estate is created equal. In addition to not all stocks are created equal. Last little thing here, just wanted to point out, we don't have a crystal ball. We do not know what 2021 will be, but these are some things I think we can count on or should be thinking are going to be substantial. I think the COVID vaccine process will drive the momentum of the recovery. If the vaccines are working, people are getting them faster, I think things will return more to a more environment that's good for business and good for the markets faster. So that's going to dictate the pace of normal business economies, and historical businesses that have done well in normal times should be more efficient. We cannot ignore the reality of the challenges that our culture is facing with racism and social justice and just different viewpoints. The thing we saw on Capitol Hill yesterday is, I don't think I would ever in my entire life imagine seeing what I saw on TV. Like that just is somehow just not even imaginable. But we might see more unimaginable things that are more disruptive to our economy than a group of folks coming in and making a big scene in a government building. So I think that wild card that's out there is likely going to give us volatility. Now the market's just kind of shrugged off what happened on Capitol Hill yesterday, or the day before, but it's there are things that can happen that will probably impact the market movements just because confidence will get shaken. Now that we know that the Senate is going to be Democratic, the House is Democratic, President's Democratic, there's an alignment there that generally speaking will be pro tax increases for the wealthy. And I'm not going to go on and say that that's good or bad, but from a financial planning standpoint, there are things we are doing and will do diligently as we get through this year to deal with some of those implications of what is likely to be a tax increase to folks that make reasonable incomes. The Trump-Biden transition, man, heaven help us, let's just figure it out, but could be volatile. So there's your roller coaster, experiencing volatility. And then the back to school thing. You know, when the kids all get back to school, things will allow more workers to go to work. And, you know, there's so much unproductivity happening because the kids are at home and their parents can't go do their jobs and contribute to the economy in normal ways. So that's kind of tied in with COVID, but I think you'll see some things happening shortly after all the kids are back in school that'll be good for the market. So those are some things that we think are going to play into the markets. Our trend strategy is very helpful because we don't have to get it right. We're prepared on whichever way it goes. But where I think you need to focus your energy as far as what's something I can do as an individual investor to benefit from these things that we see on the radar for 2021, the singular most important thing I think you can do is find a way to dollar cost average. Find a way to take some regular monthly monies and put it to work in things that are going up and down. The returns that you can get as a result of buying shares when they're cheaper, compounded over time, are generally much better than the returns that you'd get in buying something and holding it and just watching it go up and down. Obviously, there's no guarantees the dollar cost averaging is going to work. You know, investment performance is, you know, never guaranteed. Historical performance doesn't guarantee future results, but it is a very sound strategy. So if you have the means to find a way to commit yourself to doing something weekly or monthly into some investments that you feel comfortable with, that you expect volatility, it can benefit you when it's all said and done. So those are some things that we have for 2021. Guys, I'm going to need, if there's questions, because my screen isn't allowing me to see them. If anybody has a way to see them and tell me if we have questions, that would be great. Nat, if you're on, you can share.
No questions at this time.
Okay. There may be some, guys. I apologize. I'm trying to figure out how to host and be a presenter at the same time, and there's a technology challenge. But if you've put in a question, I'm going to make sure to get it answered for you. I'll get it back to you individually. Just want to wrap up by saying, you know, we really appreciate the opportunity always to serve all of you. COVID has been a heck of a thing, but we're getting through it, and many of you are as well, even though we hate what we have to do to make it work. But we're going to get through it. So with that, I'm going to wrap it up. Thank you for letting us work with you. Justin, would you mind reading through our disclosures?
Sure. The views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 index is an unmanaged index representing the largest 500 companies in the U.S. The Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in indices. The performance of any index is not indicative of the performance of any one investment and does not take into account the effects of inflation and fees and expenses associated with investing. Past performance does not guarantee future results. All investing involves risk, including the loss of principal. There is no assurance that any one investment strategy will be successful. Thank you.